Hello and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends that we've been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you are listening on, or by following #QC Weekly Comment on LinkedIn. I'm your host, Andrew Cartwright, Investment Manager based out of our Birmingham office, and this week I'm delighted to be joined by regular commentator and Head of Fixed Interest Research, Richard Carter, and by Senior Equity Analyst, Will Howlett. Welcome, Richard and Will. So with the Federal Reserve Bank having resumed the cycle of interest rates cuts in the US with a 25 basis point reduction at the end of October, all eyes were on the Bank of England last week as the Monetary Policy Committee met to set rates here in the UK. Now, the outcome of that meeting was that interest rates were left unchanged at 4%, but perhaps of greater significance was how close that decision actually was, with the MPC members voting 5-4 in favour of keeping rates unchanged. So, Richard, first of all, what did you make of that decision and why do you think it was so close? And secondly, what are your thoughts on the implications of that decision for the outlook for interest rates going forward?
Yeah, good question, Andy. I mean, I don't think it was a huge surprise because we're just at this point in the cycle where the economy's doing okay. Nothing amazing, but growth is sort of a little bit sluggish. And then we've had this spike in inflation, and we've hopefully reached the end of that. But we're yet to see CPI start to come down much. So I think there's clearly a split on the committee. Some people think we're past the worst for inflation. Let's crack on and cut interest rates, and the others, understandably, are a bit worried that inflation pressures are ingrained and want to see confirmation in the evidence. So, it's no great surprise that some of them want to wait. You've also got the budget coming up as well, which could affect matters. So, I think it makes sense that you've got this sort of a bit of a split. But I'm sure rates will come down over the next few months or so. I think there's a good chance. There's another meeting basically before Christmas. I think there's a good chance that we'll get an interest rate cut at that, provided the budget doesn't throw up any major surprises. And actually, I think the government's quite keen that whatever measures they come out with push down on inflation, because that was a mistake they made at the last budget. So hopefully, we'll get another interest rate cut before year end.
And Richard, you just touched upon the budget there, and perhaps the Bank of England's decisions shouldn't be sort of determined by what's going on the political scene. But that budget is just a few weeks away, and no doubt speculation will continue to rise in the run-up to Rachel Reeves' announcement on 26th of November. And last week we heard Sir Keir Starmer notify Labour MPs that the budget will be based on tough but fair decisions. And whilst it would not include deep cuts to public spending, he admitted that the fiscal backdrop was worse than feared. And Richard, in their election manifesto, Labour promised not to raise income tax, national insurance or VAT. And since then, of course, we've had an increase in national insurance. This could, of course, just be Keir Starmer testing the waters, but no doubt some Labour MPs will be concerned that he is paving the way for a rise in income tax. Now, we can't predict what the budget statement will actually bring, but has this changed your thinking at all on what we might expect? And how have the bond markets been reacting in the news in up to the budget?
Well, I thought it was interesting that Rachel Reeves decided to make a sort of impromptu pre-budget speech last week. We haven't really seen that much before, and that's clearly all about preparing the ground and managing expectations for the fact that this might be, just like the last one, another sort of painful budget. I mean, they've got a big hole to fill. I mean, the OBR has downgraded their estimates for productivity. That feeds through to lower growth. That feeds through to a bigger sort of shortfall in the public finances. So that's very unfortunate. I've seen estimates ranging between 30 to 40 billion pounds that they need to fill. And frankly, they can't do that with the usual kind of, clamping down on tax evasion and sort of looking for efficiencies in the civil service. So they've got to look at some of the big ticket items, and that obviously potentially includes income tax. We'll wait and see if that's what they do. Maybe they'll find other ways of saving the money, but they tried to cut spending, didn't they? Earlier in the year, and that met opposition from quite a few people in the Labour Party. So it's a difficult one. Actually, bond markets are pretty sanguine about it. I think it's interesting. Labour seems more, or Rachel Reeves seems more happier to break a manifesto commitment rather than upset bond markets and break her fiscal rules. And it's been basically another sort of sign for gilt markets that the government, although they're in a difficult state, they are very committed to getting the deficit down and avoiding a sort of repeat of the Liz Truss scenario from a few years ago. So gilt markets have been doing okay, also helped by the fact that inflation, of course, I mentioned, has now probably peaked.
And Richard, just one final question for you. We heard over the weekend that the US Senate has moved a step closer to ending what has now become the longest running federal government lockdown in history. And US equity markets seem to have reacted positively to that news, and this follows a bit of a sell-off during the course of last week. And can you tell us a bit more about the progress that has been made? And whilst the lockdown has certainly made news headlines, is it something that has concerned you, or is it perhaps a bit of a sideline political issue that, whilst, okay, it has dragged on for far too long, it was always going to be resolved?
Yeah, I mean, it was always going to be resolved in the end. And I think, I would agree with you, if these things run for 4 or 5 days, they are a sideline political issue and you can sort of shrug your shoulders, not worry too much about it. The longer it went on, and it went, it's now the longest running shutdown in history, the less of a sideline political issue it became, and more of a very important, issue for markets. You were seeing, layoffs in government jobs. You've seen disruption at airports, and also, of course, and this was probably a reasonably big factor as well, you've had those regional election results in the States which went against Trump, and the sort of longer it goes on, the more you worry about, as I say, the sort of bigger impact. So it does look like enough Democrats now support getting the government going again. It's going to probably be a short-term, stopgap, and they won't get what they want in terms of healthcare benefits and things like that. But it will be good to see it resume. The issue a lot for markets actually and the Fed has been, just a lack of economic data. It's all very well getting some of the sort of private sector surveys and whatnot, but actually what you really want is non-farm payrolls and inflation numbers. And the longer you went without those, it became, a bit like sort of looking through the fog as far as markets were concerned. So I think it'll be relief all round.
Well, hopefully that will get resolved and bring an end to the distraction that is perhaps causing. So just to now sort of looking at global markets more generally, the markets over the past 12 months have performed very strongly. And if we look at all those major indices, they're up nearly around 20% for the year up to the end of October. And whilst US technology stocks have once again led the way, the returns from equity markets have been far broader over the past year than we've seen for a long time. And a significant driver of some of the returns has been from the banking and financial sectors, and very notably within the UK and European equity markets. And over the past few weeks, banks from across the US, UK, Europe, and Asia have been reporting their third quarter results. And this includes the likes of ING, BNP, HSBC, JP Morgan, and Barclays. In addition, some banks, including the Bank of America and Nordea, have held more detailed investor days. And while such updates are fairly commonplace, it was the first investor meeting held by Bank of America since 2011. I'm therefore very pleased to be joined once again by Research Analyst Howlett, who covers the global banking and financial sectors, to find out a bit more. Will, those were just some of the names in a long list of banks and financial companies that have reported results so far, and no doubt you've been very busy during this reporting season. Could you give us an overview and some of your thoughts on how the banking sector in particular has performed during the third quarter? Have there been any particular themes or trends that have emerged? And have they generally been supportive of the very strong share price performance that we have seen recently? And just one final additional point. Do you think there was any particular reason that the likes of Bank of America and Nordea felt the need to provide further guidance?
It's been a strong reporting season for banks. I think lots of beats and some upgraded guidance. I think the themes have been solid revenues with signs that net interest income is building again, and no real issues with regard to credit quality, for example, as economies are trundling along. And then the banks are very much continuing to return capital to shareholders. So more buybacks announced at a number of the banks, for example, which the market always likes. That has tended to feed through to some decent earnings upgrades for banks, and share prices have responded as well. On the theme of the investor days, I think Bank of America is definitely worth highlighting, given, like you say, the last one was 14 years ago, and the world looked rather different then, with the bank still reeling from the aftermath of the financial crisis and all the regulation that came in response to that. Turning to today, I do think Bank of America is under a little bit of pressure. They didn't handle the interest rate cycle as well as some of their peers, which meant that they added to duration at the wrong point in the cycle. But I would highlight the deposit franchise is very strong across the US. And so the bank avoided the need to sell bonds that are underwater. And as these bonds are maturing, they will be then reinvested at higher interest rates. So they are naturally working through this issue. And it does mean that their net interest income should be building from here. I think the other criticism has been that the bank was a bit cautious, actually, in the aftermath of the financial crisis. But they did talk about improving lending growth as well. So hopefully some useful information there. The event itself was over 6 hours long and 300 odd page slide deck, so quite heavy going. But the main highlight being the commitment to getting to a 16 to 18% return on tangible equity, which I think would be supportive for the share price, certainly going forward. And another thing worth highlighting, I think, as well, is the tech spend that the banks are going through at the moment, the investment they're making there. So Bank of America highlighting over 100 billion spending on tech over the last 10 years. And I do think the biggest banks in both the US and in Europe as well do have that advantage to be able to invest in tech and get ever more efficient, which the market again tends to reward quite well.
So whilst we have seen sort of very strong performance across the banking and financial sectors over the past year, there have been setbacks along the way, and perhaps the most notable one was the concerns that arose over a couple of US regional banks, which saw a very sharp sell-off across global financial stocks in mid-October. There have also been some suggestions that the UK government might look to impose some form of tax on the banks as part of the budget. And I'm aware that some banks, such as BNP, UBS, HSBC, have been sort of facing the prospect of litigation from historic issues. And Will, there have, of course, been issues before surrounding US regional banks with the collapse of Silicon Valley Bank a few years ago. But this did seem a kind of very strong reaction. Could you tell us a little bit more about that regional bank issue and perhaps some of those other potential risks? Did it really give you sort of genuine cause for concern, or could this just be a sort of a knee-jerk reaction, and perhaps a bit of a catalyst for some profit-taking after that strong run, which we do sometimes see?
Yeah, there have been a couple of high-profile insolvencies in the US, most notably, I think, First Brands. They do seem to be related to fraud, and so it seems a stretch at the moment to think this is something more systemic, but much more idiosyncratic in nature. But the market is clearly very worried about this, and on looking for any sort of signs of incremental headlines from here. I think if you look at Q3 reporting for the US banks, we actually generally saw relatively stable trends as it relates to loan losses. And actually, they saw some improvements, for example, relating to credit cards. So I think it's one we have to keep an eye on. But for me, these look to be a couple of isolated issues, but we need to see if there's anything more coming out. As it relates to the banking crisis we saw a couple of years ago, the sell-off this time around does look quite different. So Silicon Valley was all about banks mismanaging interest rate risk, and this one is more credit related. The market never likes uncertainty as it relates to credit costs because you're never quite sure quite how bad it may become, and so they look to price in a downside scenario and then look to see how things develop from there. On those couple of isolated issues regarding bank taxes, for example, and then the litigation, on bank taxes, it does seem that the banks have been successful in lobbying against more taxes, given the messages coming out of the Treasury. But the Chancellor, as we've talked about, is in a very difficult position. So I think we should wait until the end of the month just to see what is confirmed there. And then as it relates to examples of specific litigation against the banks, there's been a few lowlights, perhaps I should say here. So BNP, as it relates to their involvement with Sudan decades ago, HSBC, as it relates to the Ponzi scheme ran by Bernie Madoff, again, moving back a couple of decades, and then UBS relating to their takeover of Credit Suisse and the AT1 notes, and these were written down to zero, and there's been a court ruling going against UBS, and so it's whether they may potentially be on the hook for some of those losses. I think again these are rather company-specific related issues, but they, like you say, they are prompting a bit of a sell down given the strength we've seen in the sector year to date. I do still think valuations are pretty discounted in financials, and you do tend to see the bank sector peaking out at a P multiple of over 10 times, and we're not quite there yet. So for me, I still feel like the sector has a little bit further to run, but there's definitely a few nerves out there, and so I can certainly understand some profit taking just recently.
And just sort of looking forward, Will, we saw that the US Federal Reserve has resumed its cutting interest rates and last month, and all the Bank of England left rates unchanged in November. The path has perhaps been cleared for further rate cuts in the not too distant future. Do you think that interest rate trajectory could have a bearing on the outlook for the banking sector, or are there any other sort of factors, whether positive or negative, that you are keeping a close eye out for that could have an impact on the sector going forward?
Yeah, I think interest rate cuts out of choice as the outlook for inflation is moderating, I think would generally be pretty positive for financial markets and also for the wider financial sector. It does potentially reduce the spread that's available on net interest income for banks. But remember, for example, that UK banks have generally protected their margins over the next few years through hedging. And it could also support those banks with more fee-related revenues, because if the central banks are cutting rates, should lead to better activity levels, more buoyant equity markets, for example, and that's all quite a good environment for fee-related revenues. If rates generally follow the path that is implied by the market, I think this is quite a benign outcome for banks generally. So I think the market is looking for terminal rates of about 3% in the US, a little bit more than that in the UK, and about 2% in the Eurozone. And so there's no return to the zero rate era, which crushed interest rate spreads for banks. And that was really following the COVID period and also the financial crisis. So that's really what hurt banks' net interest margin. So if we settle at 2 or 3%, I think that's still quite a decent environment for banks. I think one concern was definitely around rates falling more quickly than expected, and certainly as it relates to the banking sector. And so if there really is a weakening in the labour market and we get more jobs data as the government reopens, that will be interesting to follow. And then also, the potential for, the new Fed chair coming in less than 6 months as well, and more dovish members joining the Fed too. For example, Steve Mnuchin calling for 50 basis points of cuts. So if rates fall more quickly than implied by the market, I think that would be a bit more of a tough outlook for the banks. So those are the things that I think we need to be looking for: the jobs data as the government reopens, and the direction on interest rates.
So thank you, Will, and to Richard for those great insights, and to all for listening. Did you enjoy our discussion on the podcast today? We love to hear from our listeners, so please review the show now wherever you're listening and share it on your socials and tag us at Quilter Cheviot. To make sure you don't miss a future episode, tap the subscribe button. We'll be back next week, and in the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or our social media pages. Finally, do you have a question that you would like to ask one of the experts for our next podcast? Simply ask them via the weekly comments page on our website. We'd love to hear your questions. And that's it for today. So thank you again to Richard and Will, and to you all for listening. See you next time.